Hello, this is the exciting topic of finance for small businesses. This is the third of the revision recordings for Unit 1 of AQA GCSE Business Studies. And the first topic in this unit is sources of finance and support for small businesses. If I'm setting up a new business, where can I get money from? Because obviously it's going to cost me some money to set up. And where can I get help? If I'm setting up a business, the money I'm going to spend is going to go on starting up. So it's called your startup costs. Not surprisingly, I might need some equipment to set up. I might need to rent a property. I might need stock, and probably I'm going to need to advertise my new business and tell people about that, all of which costs money. I might need, once I've set up, I want to develop my business, I want to grow, I might like to get new machinery, more staff, or new premises. So obviously that will cost money as well. So where can I go for that money? Now the most obvious place that a lot of people will say to you is, well, go to the bank. And you borrow money from the bank. It's called a bank loan. You pay back the money over a set period, so you might borrow £10,000 and pay it off over 5 years and pay a certain amount every month. That's great. You can borrow a large lump sum. You don't have to pay it off straight away, and you can budget. You know, right, okay, this month, every month we've got to pay £200 back to the bank, so you can budget for that. You can plan for the repayments. However, the bank will charge you interest. They want to make their money. They're not going to give you 10 grand for free. So they want to charge you what's called interest. They'll charge you a percentage, and it means that you won't just pay back £10,000. You'll probably pay back, depending on the interest rate, £11,000 or something like that, which puts your costs up, obviously, of your startup. You have to make the repayments. If you're having a bad month in the business, or you've had a lot of money go out that month, you've still got to pay the bank back. So they might be reasons why it would stop you wanting to get a bank loan. Also, banks can be very, very hesitant about lending to new businesses, basically because a lot of businesses don't succeed. So we can understand why they might be reticent about doing that. You would need, if you were going to go to the bank and ask for a loan, you would need some kind of business plan and cash flow forecast, and they would probably ask you, whether you're a limited company or a sole trader or a partnership, they would probably ask you to put some kind of personal guarantee against that loan. So even if you were a limited company, the bank might well say to you, well, you've got to put your house up as what's called collateral, so that if you fail to make the repayments through your business, we can come and get our money back. Another thing you could do is borrow money from family or friends. Great, you've got family and friends with a load of cash. Hey, help me set up my business. Brilliant. They might say, yeah, fantastic. Interest-free loan. Don't have to pay me back at the moment. Wait till you've got the money. All very relaxed. Great. And they may, if they don't charge interest, then obviously that's cheaper than a bank loan. However, if you haven't got family or friends who've got that much money, then you're stuck. If you fall out with them in the future and they say, right, I lent you that money, I want it back now, you might have a problem. And they also might want to come along and tell you how to run your business, and that is not necessarily what you want. You might need a business plan. They might say to you, I want to see your business plan. It depends how much they know about business, and you probably do it all based on trust, but you might want to draw a document up that's an agreement between you. They might want shares in your company. So that's things to think about with friends and family. Now, another one that involves you going to the bank is what's called an overdraft. This is more of a short-term source of finance. What happens is, every month you know you've got £1,000 coming into the bank. This month you're going to spend £1,200. So you say to the bank, is it okay if I go overdrawn by £200? And they say yes, but you've got to pay it back within the next 2 months. And they will charge interest. It helps with cash flow, because obviously you could just borrow that £200 and pay it back a little bit later. But they will charge high interest rates on that. It is only short term, and the bank could turn around and ask repayment at any time. So it can be useful, but it's also got to be used with caution. A mortgage is what many of us have got to buy houses. It's a long-term loan for purchasing a building. So if you were setting up and you were buying a shop, for example, you might want to take out a mortgage to buy that shop. The rate, you can fix your interest rate usually for a while, so you know how much you're paying out in repayments. Fantastic. It also means you've got an asset to your business. You own something in your business. But if interest rates go up, it could put the price up of your mortgage, and obviously that's more money you've got to bring into the business to cover that. And also the lender might need a personal guarantee again. So for example, they might say, I want you to put your own house up as collateral in case you don't make the repayments through the business. You would need a business plan and cash flow forecast to try and get a mortgage, and yes, you would probably have to guarantee your house or something like that in case you didn't meet the repayments. Something called trade credit can be useful, probably not for a new business, but once you've got up and running, suppliers might well say, okay, you don't have to pay us for the stock until 30 days after we've delivered it. That gives you the chance to sell the stock and to get the cash in. Can really help with cash flow. It means you can buy, if you know you've got a busy period coming up, it's coming up to Christmas, lots of people will be buying your stock, so you get stock in from the suppliers in October, but you don't have to pay them until November, and by November your sales have started to come in, you've got your cash. The suppliers won't won't charge you interest, so it's a good way of being able to plan for busy periods. However, you've got to be really careful, because if you haven't paid for it up front and you forget that you've got that bill coming in, you might not have the money 30 days later. So you need to keep a close eye on your cash flow with that. To get trade credit, very often you need to get what's called trade references. So you'll have to get other people you deal with to say, yeah, they're not dodgy, they will pay you back. And that reassures the supplier that you're not going to take their stock and do a runner. Another way that, especially for a new business that's set up by a younger person or in a rural area or something, or an area where there's high unemployment, is that you can get what's called a grant. And this might be a government organisation or a charity that supports new businesses, and they give money to people to set up a new business. The biggest benefit of this is that you don't have to pay it back, but the downside is that there's not many people who qualify. It tends to be to encourage young people into setting up a business, or people who've got maybe a disability, or maybe in a rural area, or women in a certain area, to try and get them into business. But a lot of us don't qualify. You'd have to fill out lots of forms to say that you're eligible, but then if you get accepted, then fantastic. Retained profit is another source of income. If I've got profit left over from my business and I've covered all my costs and I've paid myself, then I could use that money to grow the business. A disadvantage is you're not likely to have that much to pay for anything major, but obviously it's money that you've made and you can spend it on your business. It's called retained profit. Now, another source of cash, especially for businesses that are growing, is called venture capital. And this is where other business people, like in Dragon's Den, come along, think, yes, this business has got potential, I want to invest in this. And they give you investment, they probably want a share of your business, and they'll give you advice on how to run the business. However, that can be a downside as well, because they might be telling you to do things that you don't want to steer your business in that direction, and they're going to be able to tell you what to do. So, and it depends what share they want of your business in return for their capital. And crowdfunding, this is a very recent source of income for businesses. You upload your business plan or what your business is doing onto a website, and lots of individuals give you small amounts of money that add up to a large amount. So you might want 50 grand and lots of people give you 500 quid to grow your business. In the long term, they'll want some return on that, but in the short term, you've got your money and you can actually grow your business. Now, support and advice. Many banks have business advisors. There's lots of websites out there with lots of information on for small business owners. There are some government-funded organisations in deprived areas. So, for example, in Corby, there's the Corby Enterprise Zone, and backed by the government, where they will give support to new businesses setting up because of obviously high unemployment in the area. And then you get charities such as the Prince's Trust, which helps unemployed people who are aged 18 to 30 to set up their own business. And this gives advice, loans, and a business mentor. Well, now we'll go on to the financial part of this. You need to know that sales is the same as revenue, which is the same as turnover, which is the money coming into the business from actually selling the products or the goods or the services. Now, you work out this figure, the revenue or the sales or the turnover, by saying the number sold times by the selling price. For example, if you sell 1,000 hot dogs at £2 each, you've got £2,000 worth of revenue or sales or turnover. If you want to increase the revenue, which most businesses do, you could put your price up and hope that sales don't fall, or you could increase the amount sold by putting on more promotions or discounting, trying to get more customers through the door. Now, fixed costs, don't worry too much about this, but if you've got a general awareness of this, the business is going to have some costs that are going to stay the same however much you sell. You've still got to pay your rent every month, for example. That is a fixed cost. You've still got to switch your lights on and off, and that's going to cost electricity. So your fixed costs are the ones that stay the same however much you sell. Your variable costs are the costs that change every time you make a sale. So for example, if you sell 10 pencils and they cost 50p each, then that 50p is a variable cost, because if you only sell 2 pencils and they cost 50p each, the costs are going to be less, aren't they? If you sell 10 pencils that cost you 50p each to buy, the cost on that is £5. If you sell 2 pencils that cost you 50p each, the cost on that is £1. So that cost varies depending on how many pencils you sell. That's a variable cost. Again, don't worry too much about fixed and variable if you can't understand that at the moment. Now, profit, you do need to know what this is. Profit is what is left over after you've covered your costs. So you've got your revenue. How much money have I brought into the business by selling my goods and services? Then you've got your costs that you've got to pay out for. What's left? What's the difference? So if you've sold those 1,000 hot dogs at £2 each, your revenue is £2,000. However, if my costs of buying the hot dogs, of selling them, of paying my staff are £1,500, then I've made £500 profit. If I haven't made any profit and my costs are actually higher than my revenue, then I've made a loss. And obviously this isn't what we want to be doing within a business. Now, the break-even point is the point when we've covered all our costs and the business starts to make a profit. Again, don't worry too much about break-even point, but if you can't remember it and use it in an answer, that shows that you're a good business person. So break-even, when you break even is when you cover your costs. Cash flow is not the same as profit and loss. Even a profitable business can fail if they can't cover their costs for that month, if they've got cash flow problems. If next month they're going to have loads of money, but this month they haven't got enough money to pay their debts, they could fail, even if overall they're making a healthy profit. Cash is the money that's available to that business at any given moment. A cash flow forecast shows the liquidity of the business, how much money is going in and out of the business. So it's a flow of cash in and out of the business. If the business might run out of cash for bills, then this is called a deficit. Say they've got lots of bills to pay that month, maybe they've bought in lots of stock because it's going to be a very busy month next month, then they might have lots more bills and not many sales, so they haven't got the money to pay those bills. If they're going to have extra cash in the future, then that's called a surplus, and then the business can plan to maybe expand or to buy new machinery or take on more staff. You can have a positive or a negative cash flow. If there's money left at the end, that's a positive cash flow. If there's no money left at the end and we've gone into the minus, if more money's gone out than come in, that's a negative cash flow. And on a cash flow forecast, you'll have an opening balance and a closing balance. And then the net cash flow is the difference between the cash in and out over a certain time period. You need to look for problems in the future on a cash flow forecast. If there's going to be a problem, if you're not going to be able to pay your bills, you need to think about how you could get the cash to pay those. So this could be that you increase your sales. It could be that you try and cut some of your costs. For example, cut back on promotion or cut some hours of some of your staff, or it could be that you have a short-term source of finance, such as an overdraft. If the bank can see that your cash flow forecast is healthy, they might give you a loan if you wanted to borrow money. You can set targets using a cash flow forecast. You can say, okay, we aim to be bringing in this amount of sales and to be clearing these debts by then. And obviously a forecast helps you to foresee problems, which is very, very important. Another way that you could increase the money coming into the business to solve a cash flow problem is to ask people who owe you money to pay you sooner. So if you've supplied customers with goods and they don't have to pay for 30 days, you could say to them, would you mind paying a bit earlier this month, please? And you could say to suppliers, if you're trying to reduce your costs, you could say to suppliers, can we pay a bit later this month, please? Just because of cash flow situation. And that goes on out there in the real business world. So a cash flow forecast is predicting what's likely to happen, and a cash flow statement is saying what actually happened. Make sure if you're answering an exam question that you're clear whether it's something that's already happened or not.